just want to say the second uncomfortable thing out loud, which is there was a lot of venture firms in Silicon Valley in this period of both not doing any work or diligence who also took the extra step and actually created classes and would teach teams how to create these tokens. Okay, and those artifacts, those video links and artifacts are sometimes on their website, they're still on YouTube, they're inside of Twitter. And what these folks would do, and we talked about this, the game that they played was they would get a team, they would create a token, they would also buy equity at some crazy valuation. The equity was locked up, but the tokens were not. And then they would put them on an exchange and sell them to unsuspecting people, and they would be able to dump these tokens. And if you look inside of that trend, what you're going to see, and Brian just mentioned this, those were the sale of securities, except it was done in a completely unregulated way. So if the SEC is really, and the DOJ is really going to take this FTT token issue seriously and what happened to FTX, they're going to start to look at a bunch of other tokens and token sales, and you're going to end up looking at some very well-known venture firms inside of Silicon Valley.
Hey guys, welcome back to Library of Wealth. Today we have Chamath on the All In podcast, giving us his reaction to the recent crash with Bitcoin. Plus we'll hear details on what happened with the collapse of FTX and where the crypto market is headed next. Chamath says there were warning signs, as well as a massive amount of negligence going on that most weren't aware of. He talks about the Silicon Valley venture firms that were involved and how unsuspecting investors were the ones left holding the bag when the crypto tokens were dumped. He believes that the SEC is going to be taking a very close look at many token and token sales taking place around this time that have the same framework as FTX. With the enormous capital and lack of governance that is taking place, it's no wonder people are just looking the other way. Let's listen to this interview with Chamath as he gives his reaction to the crash in Bitcoin, as well as the current state of the crypto market and what we can expect in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The whole point of crypto in some ways was, trust nobody, and decentralization is the key. But here what we see is a lot of people were tricked into trusting FTX and having their deposits there. And it was a centralized exchange, which caused all these problems. So it's like, it almost violates the principles of what the whole product market fit was supposed to be. So what should sort of the observer expect, and what do you expect as a business in terms of how governments now react to all of this? I think the problem is bigger than FTX, and I'll say the uncomfortable part out loud, and nobody needs to necessarily comment if you don't want to, but there were an enormous number of venture firms that talked their way into just completely doing zero work here. I mean, and the tip of the spear is this thing. Who's the guy that works at Founders Fund? Zebuljar? Delian, thank you. Yeah. That tweet that he had where he basically took the snapshot of the Sequoia transcript was one of the funniest things that I've ever seen. I mean, this was a $215 million decision, and Sequoia documented it and put it on their own website. And I think that's an example of something that was happening, which is people just looked the other way and didn't even want to do the layer of work.
Chamath, let me just string together a couple of things we've talked about over the past few episodes. And I think you'll agree with this point, but generally speaking, there seems to be a very heavy lack of governance in investing, given the amount of capital and the velocity of capital in Silicon Valley, particularly in private markets of late. And a lot of the stuff that's been talked about, where last week we talked about super voting shares and the founder does whatever they want and there's no governance and there's no board and there's no oversight. And particularly with this FTX situation, where clearly there wasn't a board that was, getting the necessary information, that had the necessary influence, that had the necessary controls, the meta conversation. But all of these threads tie together the concept that maybe there's not a lot of governance and not a lot of diligence going on. And the amount of money that's flowed into Silicon Valley has allowed a lot of this loosey-goosey behavior. And
I agree with you. The problem here is that this is totally
Wild West,
unregulated, wild west. So who knows what's going on, really?
And we're pushing the business, Sachs, off of the shores of the United States. As you said, 95% of this is happening offshore. What do you think should happen regulatory-wise, Sachs, in terms of America and competitiveness, or do we not need to be competitive in this?
No, I think we should be. I mean, what if crypto and DeFi is the future of finance? I mean, it's an important technology that I think we should enable through some sort of constructive regulatory framework. I think the regulators should listen to Brian and help come up with the appropriate framework. But to be clear, look, what Sam did is way worse than people going on an exchange and speculating. I mean, look, I think that people who speculated in the buying and selling of these tokens, they were using it like a casino, okay? Like, that's different than a customer putting their money on FTX and having their money get stolen. That's a big difference. So I think there's levels here. Now, Chamath, to your point about who's minting these tokens, you're right. Maybe that's like another category. But I do think that the reason why this is on a different level is because it wasn't Sam's money to give away.
I agree with you on that point, but I think don't underplay when there's an organized process to create an illegal security with special rules for them that allows the liquidity for one class of asset and not liquidity for others.
You're right. So that's a separate bucket. I don't think it's the same as what Sam did. And I don't think it's the same
I agree. No, I'm saying,
different types of grift.
That's something that needs to be looked at, and we need a constructive regulatory framework for that.
We're just peeling back the onion on this. I have a feeling that this is going to be the turning point in all of this.
That token, guys, let's be honest, is not the only token that has been engineered by Silicon Valley venture firms. And it is also not the only token that's gone to zero that was engineered by Silicon Valley venture firms. My biggest purchase ever was Bitcoin in 2011. I've bought a bunch of these tokens that have massively depreciated in value. I think lots of investors have. I kind of fell into it as well. Like, I thought, wow, this is incredible. I get to buy these tokens. They do all of this cool stuff. They represent all this value. And my experience has been the opposite of that. I've lost a lot of money in these things. And so, I really hope that regulators, not just obviously, I hope that regulators do the best they can to get investors' money back in FTX. But I really also hope they figure out all these other tokens as well, because you can just rank them in terms of market cap, start at the top and work your way down. And you will see that these were unregulated securities, Jason, that were manufactured and sold by our brethren.
People who understand the law around accredited investors and this stuff very well.
Yeah.
They understand it implicitly.
Do you guys think crypto investing is dead? Or what do you think? How do you think people think about that risk profile now inside of
I think
venture,
investing in the tokens is going to end. Investing in the corporation is going to begin. And any of the tokens are going to be super regulated. Building on what you said, Chamath, about the ultimate bet, is it possible that Alameda, the trading hedge fund, was looking at the FTX data, which they had insights into, and essentially that's the same as seeing the whole cards in the ultimate bet. And so they're making their trades based on what they see the consumers are making their trades, front-running their trades or otherwise.
That's not illegal. Citadel does this in the regulated market. That's what payment for order flow is. It's the ability to front-run retail volume. In dark pools, that is legal by the law in the United States, and that's what allows Citadel and I think Jane Street and Susquehanna, all these folks basically run these dark pool exchanges.
Chamath says that his largest purchase ever was Bitcoin in 2011. Bitcoin is currently down nearly 1.5% as a result of the FTX bankruptcy, which has caused market chaos and risk-off sentiment. Major cryptocurrencies are trading in the negative as the global crypto market cap fell 2% on the previous day to $855 billion. Over the last 24 hours, total crypto market volume fell 33% to $96.7 billion. One thing is clear, the collateral damage from this recent crash in cryptocurrency will be felt for weeks and months to come. Many analysts believe that Bitcoin will be reaching the bottom soon at 12 to 13,000, which is a likely scenario given that there's so much panic in the crypto market right now. What do you guys think about Chamath's sentiment on the current state of the crypto market and where we're headed next? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.